Alright folks, hold up a second, put down whatever you are doing, and listen to me about something big that is shaking up the financial world lately. In the last month or so, Wall Street has seen some seriously strange stuff happening. Four of the top players, almost at the same exact time, made the same move. It is not a coincidence, it is a warning first. You have Warren Buffett. His Berkshire Hathaway's cash reserves shot up to $7 billion. That is an all-time high. Think about that for a second. Second, there is the year-old Wall Street whiz, Kid Lopeep. He used $7 billion to short Nvidia. Yeah, you heard that right, billions. Third, the big short himself, Michael Burry, publicly warned that Nvidia's purchase commitments had surged by 100 times in a single year. That is a massive red flag. Fourth, Howard Marks of Oaktree Capital. He came right out and said, "This current market is baffling," and he is sitting on cash waiting. Now, usually these four top players, they do not even talk to each other, and they rarely act in unison. But this time, they all did the same thing. They retreated. And what are us regular folks doing? We are still chasing highs, still adding to our positions, still dreaming that AI can go up another 5 times, that the US stock market can hit 60,000, that this time it is different. But I have to tell you, every single time this time it is different. It ends up being the exact same old story. So, the big question is, what 5 things are these 4 top players really doing? Can ordinary people copy them? And if we do, can it really save us 10 years of detours and help us seize a once-in-a-lifetime opportunity to turn things around? Over the next little while, I am going to break down these 5 things for you, one by one. With real data, let us talk about the first thing, hoarding cash. Look at the real data here. On May 2022, Berkshire Hathaway released its first quarter earnings report. Their cash reserves hit a record $7 billion. That is over 30 trillion in RMB. What does that even mean? That number is bigger than the GDP of Iceland, Cyprus, and Malta combined. Even more frightening, cash reserves accounted for 40% of Berkshire's total assets, surpassing the market value of its stock holdings for the first time. This means that more than half of Buffett's empire is no longer in stocks, but sitting in cash, sleeping. Now, I want you to think about this. This man, the so-called Oracle of Omaha, has been telling the world for 60 years, buy stocks, buy good companies, hold for the long term. But now, he himself has moved more than half of his wealth into cash. What kind of signal is this? It is a silent warning. It is a warning written with a $1 billion difference. Let us look at even more disheartening data. In 2022, Berkshire Hathaway underperformed the SP 500. So far in 2022, Berkshire is down 0%, while the SP 500 is up 2%. That is a gap of over 11 percentage points. By all accounts, after underperforming the market for so long, they should be buying stocks like crazy. But Buffett and Abel chose to stand pat. Why? Abel said at the 2022 shareholders meeting that it is necessary to hold a large amount of cash, that it has strategic significance. Translated into plain language, it means, we see dangers you do not, but we cannot tell you, so we are using cash to tell you to retreat. Here is an even more explosive detail. Berkshire is keeping its cash in 3 to 6 month short-term U.S. Treasury bonds. At the current 1% yield, that is almost $2 billion in risk-free annual income. What does that mean? Just the interest from the cash alone can earn a small bank's entire annual profit. Buffett is using his actions to tell everyone that now is not the time to attack. It is the time to defend. It is the time to harvest and go home to count your money. So, can ordinary people copy this? Of course. How exactly do you do it? Step 1. Keep at least 70% of your investment portfolio in cash. Step 2. Do not put it in low-interest savings accounts. Put it in money market funds or short-term treasury ETFs. Step 3. Do not chase highs just because you see prices rising. Do not get envious when you see others making money. You need to save your bullets for real opportunities, not the current high-flying bubbles. This is the first thing I am telling you, like the stock god. Learn to hoard cash, learn to wait. Now let us talk about the second thing. This one might be even more shocking. The year-old Wall Street whiz kid, Leo Pete, suddenly made a huge bet shorting Nvidia. Look at the real data. On May 2022, Situational Awareness LP disclosed its holdings report. The fund size surged from $1 billion at the end of 2022 to $6 billion. Its size more than doubled, increasing by 2 times in half a year. But the truly explosive part is that Lopeep used $7 billion to establish put options. The short targets included the Vanex Semiconductor ETF, Nvidia, Oracle, Broadcom, Advanced Micro Devices, AMD, Micron Technology, TSMC, ASML. It pretty much covered the entire AI chip industry chain. Notice that these few targets combined account for almost whoosha% of the portfolio. This was not just dipping a toe in the water, it was an all-in short. ARSA Jan year. Old fund manager actually dared to use $1 billion to short the world's craziest sector. That is serious guts and sharp judgment. How did he do it? Ted's core logic is that the bottleneck in AI industry development has shifted from GPU chip constraints to limitations in power supply, physical space, and computing power. Simply put, he is not bearish on AI itself. He is bearish on NVIDIA's sky, high valuation, which he believes is built on a misunderstanding of the actual bottlenecks. The real bottlenecks in the future are not chips, but power and the physical space for data centers. And NVIDIA's valuation completely fails to reflect this. In other words, Leopold saw that NVIDIA was overvalued to the extreme of a bubble. Even more frightening, IOPO is not alone. His fund size surging from $1 billion to $600 billion means that a large number of top institutional investors are entrusting him with their money, betting that NVIDIA will fall. So, how can ordinary people copy this? I do not recommend directly shorting. The risk is too high, but you can do two things. First, be wary of the downside risk of high valuation AI stocks. Do not heavily invest at high levels. Second, pay attention to the real bottlenecks of AI power, data centers, energy. These undervalued sectors might be more worthy of long-term holding than NVIDIA. This is the second thing. Like Leopold learned to identify the real bottlenecks. Do not blindly chase hot stocks. Let me add another even more disheartening detail for you. Leopold graduated from Stanford University, and he entered the field of AI research at the age of Archer. He is not from a traditional finance background, but someone who truly understands AI. Precisely because he understands AI, he can see where the ceiling of AI company valuations truly lies. He has said in public speeches that the market's valuation of AI chip companies is based on an assumption that the demand for AI training and inference will grow at a rate of 17% per year. But the real bottlenecks are power, cooling systems, and land for data centers, and these bottlenecks cannot be solved within 3 to 5 years. In short, he understood that it is not that there are not enough chips to sell, but that the power supply cannot keep up, and NVIDIA's current market capitalization completely fails to reflect this real bottleneck. Even more disheartening, the investors in Leopold's fund are not ordinary retail investors. They include the Dartmouth Alumni Fund, the Harvard Endowment Fund, and the Stanford Alumni Fund, among other top institutions. A group of top institutions entrusting their funds to a RSA Jan year, old to bet on NVIDIA's decline. What does this mean? It means that the top academic and financial circles have reached a consensus that NVIDIA's valuation is too high, the market is overheated, and the risk is extremely high. Now let us talk about the third thing. This comes from someone we all know, Michael Burry, the person portrayed by Christian Bale in the Big Short movie. During the 1990 financial crisis, he made $1 billion by shorting subprime mortgages. And now, he has spoken again. Look at the real data. Burry pointed out that NVIDIA's current purchase commitments amount to $1 billion, while a year ago, this figure was only $1 billion. That is a 1.9-fold increase in 1 year. $1 billion divided by $1 billion equals 1.9. What does this mean? It means NVIDIA has promised its customers that it will procure $1 billion worth of chip raw materials, components, and manufacturing capabilities. But this commitment is based on an assumption that AI demand will continue to skyrocket. If AI demand slows down or hits an inflection point, NVIDIA will have to bear huge inventory risks. Historically, every time purchase commitments have increased by more than 5 times, it has been accompanied by the arrival of a demand inflection point. Take a recent example. During the cryptocurrency bull market in 1990, NVIDIA's purchase commitments also surged 5-fold. As a result, when the crypto bear market arrived in 1990, NVIDIA's market capitalization once fell by 2%. Every time the story of demand will never fall was told, it was ultimately proven wrong. Burry's warning this time is not predicting a collapse, but reminding everyone that when a company's supply chain commitments inflate to astronomical figures, it has already tied itself to a script that cannot fail. Even a slight deviation from the script will result in huge costs. An even more explosive detail is that Burry not only warned about NVIDIA, but he also quietly shorted the entire semiconductor sector, including Broadcom and AMD. This is almost perfectly consistent with Leopold's judgment. The RSA Jan year, old new stock god, and the Dosha Jan year, old short. Two people who should not know each other actually place the same bet in the same position. This is no coincidence. This is the consensus of truly smart money. So what can ordinary people do? First, do not be fooled by epic growth stories. Any exponential growth eventually has it. Look at the company's supply chain commitments. If a company's purchase commitments surge by more than 5 times their original amount, please be alert. That could very well be a sign that a bubble is peaking. Third, pay attention to downstream demand in the industry chain. If downstream demand slows down by even 1%, the entire upstream will be impacted by a factor of 10. This is the third thing. Like Burry, learn to identify the gap between promises and reality. Do not let promises trap you. The fourth thing comes from Howard Marks, co-CEO of Oaktree Capital. Oaktree Capital manages over $14 billion, making it one of the largest alternative asset management firms globally. Marks has a famous saying, "We cannot predict the future, but we can determine where we are now." And in early May, he publicly stated that the current strength of the market is baffling, and he is holding cash, waiting for an opportunity. Notice the word baffling in that sentence. It is not worrying, it is not alarming, it is baffling. What does baffling mean? It means that according to all normal logic, the market should not be rising this high, but it is, and it is still rising. When a person cannot even understand why the market is rising, the only thing they can do is to exit. Marks has experienced at least 5 major financial crises in the past 6 years. The 1998 stock market crash, the 2000 internet bubble, the 2008 financial crisis, the 2020 COVID crash, the 2020 interest rate hike bear market. Before every crisis, the market always exhibits a common characteristic. It rises to a point where even professionals cannot understand it.